Folks, you better get ready because we've got a lot to get into today, and it's going to be very, very important that you watch this video to the very end because shite is hitting the fan. You have the NASDAQ down 6% at some points. The 7 most valuable U.S. tech companies lost a combined $1 trillion in market value. The overall market, several trillion gone this morning. You had major brokers crashing all morning. Charles Schwab, Fidelity, Vanguard, TD Ameritrade, E-Trade, Interactive Brokers all reported huge outages this morning. Bitcoin went down some 15% plus at points, rest of crypto market crashing as well. Now, here's the thing you got to keep in mind here, folks. If you look at the VIX over the last 20 years, and the VIX, again, is our fear and volatility index that people buy when they're hedging. They buy options and VIX goes up. Well, where were the 3 biggest days? Well, number 1, the 2008 era crash. Number 2, the COVID crash in 2020. And then number 3, today. Those were the 3 biggest breakouts of VIX over the last 20 years. And actually the biggest in history as well. So what exactly happened today that put us in the same category that we've been in only 3 times in modern history? You look at the overall market, I mean just brutalization across the board. Apple down massively, Amazon, Tesla, Alphabet, so on and so forth. The list goes on and on and on. And you got to remember, folks, that when it comes to the stock market, performance only takes 4 shapes. A pentagon, a hexagon, an octagon, and a portfolio gone. If you look at today's market, which do you think it was? So what's going on here? We're going to cover the 3 major points that you need to know. Number 1, the Japanese market contagion. What it is, why it's happening, and whether it's likely to spread. Number 2, the war escalation in the Middle East, and what markets are worried about with that. Specifically, a few data points that you got to watch. And number 3, we need to talk about the economic crisis that's already bludgeoning here at home and why the Fed is already warning that they might have to come in and fix the problem. And that's a direct quote. Fix it. In today's video, we're going to go through everything that you need to know. And as always, make sure to do your own due diligence on all ideas presented here on the channel. If you're the one taking the ultimate risk, you got to be the one doing the ultimate frisk. Lots of people get real risky without doing their frisky, and that's a big problem. Stems a lot of the issues in today's society. And today's video is brought to you by our absolutely free email newsletter. Right now, with all this volatility, there's a lot of opportunities, and if you want the hottest and best ideas that we know how to give you for absolute free, well, I'm going to go ahead and put the link to that down below. Obviously, we have our premium picks in ZipTrader U and ZipTrader Options, but our newsletter is the first place to start. We want you there. We want you there to get our free research and to build the relationship with you. And I personally guarantee you're going to see a lot of value in it, so make sure to check it out. First link down below. Okay, let's go ahead and start with Japan. So Japan's market suffered its biggest fall since 1987. But what caused this crash is also what caused the U.S. meltdown. And that's what's called the carry trade. Not the Jim Carrey trade, but the carry trade. I promise you this one's a lot more wacky. The Japanese carry trade is an extremely popular investment strategy where people borrow money at the low interest rates in Japan and then invest it elsewhere, namely in the United States, where interest rates are much higher. You can get more of a return in the stock market, so on and so forth. Whether you're investing in just T-bills at 5 to 6%, or you're investing in the stock market, which has returned dozens of percentage points over the last couple of years, well, this has been a very, very profitable strategy. This strategy exploits the low cost of borrowing in Japan and takes advantage of the higher returns elsewhere because the rest of the world has much higher interest rates on just fixed income assets. But outside of that, also has better returns in equities. And this is actually a great strategy. It's all fine and dandy until Japan starts raising their interest rates and protecting their currency, the yen, which of course is what's happening right now. Japan is now raising its rate above 0 for the first time in 17 years. So investors and massive institutional players who use this strategy are now being margin called and have to liquidate back into the yen, but the yen is strengthening so fast that they are losing money on the conversion at the same time that global equities are crashing, causing even more margin calls to occur. And this is a big stinking problem because there's going to be a massive unwinding of all this Japanese carry trade capital. You saw just the beginning and the panic associated with a rapid unwinding today. But what you don't see is all the other capital that is still wound up in this type of trade. It appears that there's a lot more here than meets the eye. And as the Japanese yen continues trending upward, well, that means that any US dollars converted back into the yen are going to have eroded value, which makes the whole process even worse and makes margin calls that much more painful. So what exactly is the extent of the damage here? Well, if you look at the level of cross-border bank lending in yen, well, as of the latest report, you have around a combined 250 trillion yen in interbank loans and loans to non-bank financial institutions in cross-border lending. 250 trillion yen is how much, Charlie? Well, it's about $1.74 trillion. That's a lot of money, and it's really just the tip of the iceberg. Remember, every single dollar that needs to be recalled and sent back to yen that gets ripped from the market is going to have a multiplying effect across the financial system. Folks that get margin called aren't going to have the immediate liquidity to fulfill the calls. So that means that a lot of assets are going to be pushed farther and farther down to panic level prices. Now, to which assets and to which extent this is going to happen, we're going to find out over the coming weeks, and perhaps the Bank of Japan can decide to reverse their policy before this gets even more entrenched. But at the same time, when you have trillions of dollars on the chopping block, that's very, very dramatic. Quite frankly, folks, if you do a little bit of research, you find that this chart, well, it's really just a small portion of the overall problem. The much bigger problem is the fact that the government of Japan itself is essentially involved in one massive $20 trillion carry trade. $20 trillion. How exactly does that work? How could the Japanese government be involved in this? Well, the Japanese government's balance sheet as a percentage of GDP is around 505% now. Japan has borrowed so much in other currencies and relative to its own GDP that now by raising rates and strengthening the yen, it's all of a sudden creating a unique financial crisis that nobody has ever experienced before. From Zero Hedge, quote, at a gross balance sheet value of around 500% GDP or 20 trillion, the Japanese government's balance sheet is, simply put, one giant carry trade. It goes at the crux of why it has been able to sustain ever-growing levels of nominal debt. But now that Japan is raising their rates, well, it's creating a huge margin call for their own national finances and their own national security. And you could say, well, hey, wait a second, maybe Japan can just lower their rates again. Maybe that would be fine. And certainly that might be a possibility, but long term, that's not really that great of an option. Not if they want to protect their currency from further collapse. So in other words, if Japan decides to continue to make efforts to save their yen, well, you could expect more of this carry trade induced panic. Again, just today alone, we saw a rip of around $1 trillion on just the start of this from the biggest stocks in the stock market, trillions more if you look at the overall market. So if this does fully unravel or only half of it unravels, you can expect a lot more downside pressure. Now, the second part of the crash today comes from a completely different layer, which is the Middle East conflict and the escalation there. Now, obviously, it's been a rough situation over there since the October 7th attacks, but as of the last couple of weeks, it's heated up quite a lot. And now with the offing of the Hamas leader in Tehran and a senior Hezbollah commander in Beirut, well, now Iran is warning of direct punishment coming for Israel and what is sure to be a big escalation, which may or may not have happened by the time you watch this video. Now, here's the thing, though. If you want to know what's going to happen and what the people with money, power, and connections think is going to happen, just look at the Lockheed Martin stock. And by the way, I'll bet you anything that the filings for Congress in a couple of weeks are going to show that lots of Congress people bought Lockheed Martin stock and other defense contractor stocks in the days prior to today, because they had been briefed on all these different things that are about to happen. But anyways, why did Lockheed Martin pump early on? Well, because they are a big defense contractor, and if the U.S. sends weapons to our allies, or if it throws more money into shoring up of our stockpiles to prepare for the increasing chance of World War III, well, then it needs to buy from companies like Lockheed, and thus its stock saw huge purchasing this morning. It's already been reported that the U.S. is sending more forces to the region ahead of possible Iranian attacks on Israel. This is from Axios. Quote, Secretary Austin has ordered adjustments to U.S. military posture designed to improve U.S. force protection, to increase support for the defense of Israel, and to ensure the United States is prepared to respond to various contingencies, the Pentagon said. As a result of this, you also saw oil prices and energy plays pump early this morning as well. But what are some other impacts of this? Well, a widening conflict in the Middle East could lead to further significant disruptions in global trade routes, but obviously the bigger problem here is if it drags in a ton more players. And that is something that we're all scared of. But certainly, if you're looking at this from a stock market perspective and you're wondering why the trading is getting so crazy over the last week, well, it's because a lot of people are starting to try to price in the impact of more players being drawn into this. Turkey, for example, has been super sympathetic, way more sympathetic than they've been in attacks in the past. They have an embassy in Tel Aviv, and they just lowered that embassy's flag to half-mast in response to the killing of the Hamas leader. And this comes at the same time where analysts expect Turkish President Erdogan to potentially send Turkish forces if Israel enters Lebanon, which of course that would be a massive mess considering that Turkey is a NATO member. Turkey is one of the more powerful countries in NATO, and this would risk putting NATO allies really at odds with each other, more than they already are. But overall, more players, more escalation, more chance of U.S. direct involvement which I think nobody wants, except maybe the defense contractors and some wackos. Next, the Fed. Now, there's lots of folks calling for the Fed to do an emergency meeting and perhaps an emergency rate cut. And for context here, I mean, the Federal Reserve only convenes unscheduled emergency meetings to alter its policy stance in the most critical of situations. If you look at the long-term historical data, well, the last occurrence of an emergency meeting was on March 15th, 2020, when central bankers drastically reduced borrowing costs, and we covered this at the time, but they drastically reduced borrowing costs to near zero as the COVID pandemic instigated widespread panic and disrupted global market functions, and it was very necessary. But at the same time, today, Monday, the market decline was not as severe. Even at lows, it dropped less than half the amount of that one particular pandemic day. But there's a few other points that threaten the Fed's mission. Unemployment data from Friday, bad. Earnings starting to weaken across the board. Consumer sentiment looking bad. Consumer debt looking really bad, going up aggressively. Instability around the world, so on and so forth. All of these things point to more reasons for the Fed to cut rates. At the same time, I mean, inflation is heading towards the Fed's target. So the idea that inflation should be a top concern right now is probably not really very realistic. We're heading into a deflationary, recessionary, panicked environment right now, and the Fed, who is far too late to raise rates, is likely going to be far too late to cut them. And that's what you're seeing from Bill Ackman. He said that. That's what you're seeing from a lot of other experts, analysts, business leaders as well. This morning, there was a 60% chance priced in that the Fed was going to do an emergency 3/4 basis point cut. Right now, it says 20%. We'll see what ends up happening. But here's the flip side of this. If the Fed does come out and say, yeah, we're going to have an emergency meeting, and then they decide to cut rates, well, that's going to tell markets that, shite, we must be in a really, really big storm, because historically, the Fed only does this in the most dire of situations. So it's kind of a double-edged sword here. Right now, all you can expect is volatility, 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 opportunity in the volatility. But if you're somebody that expects the market to continue to go straight up, you're probably going to be left holding the bag. You got to be somebody that looks at the opportunity as it is, an opportunity to trade massive moves to the upside and the downside, but not an opportunity to just randomly buy and hold. Now, what have we heard exactly from the Fed in light of what came out today? Well, Chicago Fed president came out this morning and said if economy deteriorates, Fed will, quote, fix it. Why would he come out now? Why is he saying this? Well, remember, the Fed likes to use their soft power, their speech, to guide markets to stability without actually having to do anything. They say, oh, don't worry, don't panic, we got you. And then the market tends to panic a little bit less. And then the Fed never had to do anything really. But this is probably not going to be enough. He said, quote, should we reduce restrictiveness? I'm not going to bind our hands of what should happen going forward because we're still going to get more information. But if we are not overheating, we should not be tightening or restrictive in real terms. And there's some experts outside of the Fed that are really, really signaling that we need an emergency cut right now. So it's possible the Fed isn't reacting hard enough on this. If you look at this Professor Jeremy Siegel quote, he said he called for an emergency meeting of the Federal Reserve this morning. Speaking on CNBC, Professor Siegel urged the Fed to immediately cut its benchmark rate by 75 basis points or 3/4 of a percentage point. And if you look out there, there's a lot of people saying the Fed is screwing up right now. So anyways, let us know what your thought process is on this market condition. Is the Fed going to bail us out here, turn the money printer back on? What is going to happen next? You can let us know down below. But until we get more information here, keep in mind that some of the best plays in the market are going to be these beautiful volatility indices, some of the small cap plays that have catalysts, and so on and so forth. So keep an eye out. Make sure to sign up for our absolutely free email newsletter, and we will see you in the next video.